When I am talking about the financial statements that is prepared by the partners. Okay, what are the financial statements that is prepared by the partners? First statement that they prepare is the income statement. From the income statement, what will you get? You go from the income statement, what will you get? Profit for the year. What will you do for this profit? Will you divide it directly or you will do some adjustments? Okay. If there is no deed, if there is no partnership deed, then whatever profits you get, you divide directly. Okay. If there is any partnership deed, if there is any partnership deed, then first you need to do adjustments. Okay. These adjustments are happening between the partners and firm. So if there is any partnership deed, then you will first do adjustments, and these adjustments happen between the partner and the firm. Where will you do these adjustments? In which account? These adjustments you will do in which account? See, you get the profit from the income statement, then you want to do adjustments. Adjustments between the partners and the firms. So this adjustment is done in profit or loss appropriation account. Okay, this adjustment is done in which account? Profit or loss appropriation account. Profit and loss appropriation account will start with the same profit that is there in the income statement. Then what will you do? Then whatever adjustments are there between the firm and partners, you will do those adjustments and you will arrive at what figure? You will do those adjustments and you will arrive at what figure? It is called the residual profit. What is it called? Residual profit, or it is called the net divisible profit. And this same amount will be shared between the partners. You will write share of profit. This same amount will be shared between the partners. I say if I have partners A and B, whatever amount you get, you will share it, and this amount will always be equal to this amount. So can you repeat? What are the financial statements that is prepared by the partnership? First is income statement. From the income statement, what do you get? Where will you take this profit? You will take this profit to the profit or loss appropriation account. Okay. So this is called the profit before appropriation. What is it called? Profit before appropriation. What is appropriation? Appropriation is adjustments that you do between the partners and the firm. Yeah, profit before appropriation and after interest on loan. That I will tell you later. After interest on loan. After you do these adjustments, what will happen? You will get the residual profit, is also called what? Net divisible profit. And then what will you do? You will distribute this profit. You will distribute this profit amongst the partners. Are you with me? Okay, fine. Now let's see. You prepare profit and loss appropriation account and partners capital account together. Okay. Profit and loss appropriation account and partners capital account together. Whatever the partner will get from the firm will come on the credit side of partners capital account. Whatever the partner gets from the firm will come on the profit and loss account credit side. Okay. Whatever the partner will get from the firm will come over here. Whatever the partner gives to the firm will come over here. Exception is, first, here you will have the capital balances and here you will have the drawings. Let's look at the point. First, you will prepare income statement. How does the income statement look? Revenue minus cost of sales. What will you get? Gross profit, add other income. What is the other income? Whatever is there. Minus other expenses. In this other expenses, there is one thing which happens between the partner and the firm. I'm repeating. One thing that happens between the partner and the firm. It happens between the partner and the firm, but it comes in the income statement. Everything else that is happening between the partner and the firm, that means the interest on drawing, interest on capital, salary to partner, commission to partner, everything that happens between the partner and the firm usually goes in the appropriation account and capital account. But there is one thing that happens between the partner and the firm. There is a transaction between the partner and the firm. Between the partner and the firm. It should go in appropriation account, but this one exception that happens between the partner and the firm will come in the income statement, that is called the interest on loan. What is it called? So interest on loan is something that happens between the partner and the firm. Who is taking loan? The firm is taking loan from the partner. In this case, the firm tells that I can take loan from anyone. You are the partner, that is an added advantage, but I will treat you as an outsider. So the firm treats partner as outsider when the firm takes what? Loan. And interest on loan is recorded as other expense. Okay. Other income minus other expenses, what will you get? Profit for the year. What will you get? Profit for the year. This profit is called profit before appropriation, or you could say profit after interest on loan. What is it called? Profit before appropriation or profit after interest on loan. Where will this profit go? Profit and loss appropriation account. Where will this profit go? So your profit and loss appropriation account will start with profit for the year. Okay. Then you will add the income from the partners. What could be the income from partners? Interest on drawings. So you will add the income from partners, that is the interest on drawings, you will add it. Total you will take outside. So you will add the income from partners. You will subtract the expenses towards partners. What are the expenses towards partners? Interest on capital. Maybe you're giving salary to partner. You're giving commission to the partner. So after subtracting it, you will get an amount over here. From this, you will deduct this, you will get net divisible profit, which is also called what profit? Residual profit. What profit? This residual profit you will share amongst the partners in the profit sharing ratio. I'm just putting this on pause. I want you to first understand the income statement and the appropriation account. Memorize, write the format, and then I will take you on. Now you know how to prepare a profit and loss appropriation account, correct? You know that your profit and loss appropriation account would start with what? It will start with profit for the year. That profit for the year is called what profit? Profit after interest on loan and profit before appropriation. Are you all with me? It is called profit after interest on loan, profit before appropriation. Now you will start with the profit for the year. Can you see where is the profit for the year over here? Sorry? Here. You have the profit for the year as 24,500. Are you with me? Okay. So where will this profit for the year go? You will start your appropriation account with profit for the year. So you will start your appropriation account with profit for the year. After that, what do you do? You will add income from partners. What is the income from the partners? What is income from partners? Interest on drawings. What is interest on drawings? Drawings is 12,500 and 10,000. So what would be the interest on drawings? Sorry, there is interest on capital 10%. Okay, so this is income from partners or expense towards partner? Expense. Partnership salary, income or expense? Expense. Is there any interest on drawings given over here? No, there is no interest on drawings, so you will not add anything. Less, what will you do? Less expenses towards the partners. So what is your expense towards partners? First is interest on capital. Okay, you can see interest on capital. So what is the capital amount? 30 and 25,000. So you will do less expenses towards the partners, 10% and 10%. Okay. After that, what is there? Salary. Salary is given only to Anne. So less expense towards partner, salary to Anne, that is 4,000. Now see, you have your profit for the year as 24,500. There was no income from partners. There is expense towards partners. Understand the columns that you're putting. Interest on capital is there. You will write Anne and Bindu. What is the capital for Anne? 30,000 into 10% for Anne. 25,000 into 10% for Bindu. This is the interest on capital. Are you with me? Then you have another expense towards partners is what? Salary to Anne. Okay, after you subtract this from the profit, you will get the net divisible profit or the residual profit. Net divisible profit or residual profit. This net divisible profit or residual profit is to be shared among the partners. So when you're sharing it amongst the partners, you will share it in the profit sharing ratio. And this is done with the profit and loss appropriation. Now, pause the video, solve it. Then I will teach you the capital account format. Okay. Now understand, when you're preparing your partner's capital account. Okay, sorry, partner profit and loss appropriation account. So when you're preparing your profit and loss appropriation account and partner's capital account, these two accounts have things that is related between the partners and the firm. So these two accounts have things that is related between the partners and the firm. So anything that happens between the partners and the firm, with one exception, what is that one exception? Interest on loan. So anything that happens between the partnership and the firm, with one exception, that one exception is interest on loan. Other than interest on loan, anything that is happening year and year in between has to come like over here. Are you with me? Now understand, there is a format for capital account. You just need to understand that format. C for capital, C for credit. Partners capital account will always have a credit balance. So when I have a balance begin down on the credit side, it is always the capital. Okay. Partners capital account always has a credit balance. So when I have a balance begin down on the credit side, it is always the capital. Now if I see this sum, what is the amount of capital? 30,000 and 25,000. Can you see this? So capital will always come on the credit side. Are you with me? Sorry. The capital, if I have a column, so I have one An and I have one Bindu. So I have An and I have Bindu. So An, this is An's column and this is Bindu's column. Okay. Capital of An will come in this column. So I have An column and I have Bindu's column. So capital of An will come in An's column, capital of Bindu will come in Bindu's column. So Anne has a capital of 30,000, Bindu has a capital of 25,000, and I have balance begin down. Capital account always has a credit balance. On the credit side of the capital account, this is the capital balance. Okay. Year capital, year drawings, D for drawings, D for debit. On this side capital, on the left debit side, there will be drawings. You have the drawings of Anne and Bindu, that is 12,500 and 10,000. So you will put that 12,500 and 10,000. Are you with me? This is one thing that will not appear in appropriation account, but it will come in the capital. After that, everything is happening in between. After that, everything is happening in between. Okay. Year capital, below that interest on capital. Okay. Your drawings below that, interest on drawings. Here, whatever the partner is getting, whatever the partner can get, the partner can get salary, the partner can get commission, the partner can get anything else that you will write over here. And if they're getting share of profit, then you will write profit. If they're getting share of loss, then you will write loss. Okay, so this is how the capital account looks like. How will your capital account looks like? Capital balance, drawings, okay, your interest on capital, your interest on drawings, and here anything else that the partner is getting. Anything else that the partner is getting. So you, when you're making the capital account, you will definitely need an appropriation account. When you're making the capital account, you will definitely need appropriation account because you have already done calculations for interest on capital, interest on drawings over here. Let's check. Okay, let's check. This was my appropriation account. This is my appropriation account, and they've asked me to prepare a capital account. Okay, opening capital will be over here. Opening capital will be over here. Are you with me? Okay. Opening capital will be over here. So this capital amount will come over here. Drawings. Drawings is over here. Only except for the first line, everything else you will get from the appropriation account. I'm repeating again. Except for the first line, everything else you will get it from which account? From the appropriation account. Now come here. Your interest on capital. 3,000, 2,500. Salary. 4,000. Okay. Here, whatever the partner is getting. Then over here, interest on drawings. There was no interest on drawings. Was there any interest on drawings? No. Then share of profit. This partner is going to get. Partner is going to get. Yeah. So partner is going to get. So I will record it over. Then I will close this account. You will close one by one. First, I will close Anne. I'll close Anne. Okay. The total of the credit is more 46. I will write the same 46 here. From that, I will minus 12,500. I will get 33,500. This is the closing capital. Opening capital on the same side. Closing capital on the opposite side. I'm repeating. Opening capital on the same side. Closing capital on the opposite side. Opening capital, same side. Closing capital, opposite side. Similarly, for Bindu, the credit is more. I will write this on both the sides. From this, I will minus the debit. I'll get this. Now, I want to teach you one thing over here. Anne's opening capital was how much? 30,000. Anne's closing capital is how much? So that means the opening capital is different from the closing capital. That means the capital balance is fluctuating. It is changing. Why is it changing? Because I am doing all the adjustment that is related to capital in one account. Yeah. Everything that is related to the partner, everything I'm putting in one account. So when I am preparing one account for the capital, I'm repeating, when I am preparing one account for the capital, opening capital will be different from closing capital. So this method is called fluctuating capital method. What method it is called? Fluctuating capital method, when the capital balance keeps on changing. Okay, so you have one account of capital. We are following the fluctuating capital method where all the adjustments is done in the capital. Okay, opening capital, interest on capital, anything that the partner is getting. Drawings, interest on drawings, closing capital. This is how the capital account looks like. Now for the same sum, I wanted to prepare capital account with the help of profit and loss appropriation account. You can pause, you can do. was not recording. चलो बनाओ. नहीं. Pause recording. Your previous thing, your opening capital was different than your closing capital. Are you all with me? Okay, your opening capital was different than the closing capital. But sometimes what happens is, whenever I am calculating interest on capital, what am I calculating? Interest on capital. So sometimes what is happening is that when you want to calculate the interest on capital, these partners say that it becomes very difficult. We don't understand whether we have to calculate an opening or closing. We want the capital balance not to be touched at all. The capital should remain what? Fixed. What do the partners say? So sometimes the partners will say that we don't want the capital account balances to keep on changing. From 30,000 to 33,500, we don't want this to keep on changing. We want the capital to remain what? Fixed. What did we want the capital to remain? Fixed. No, they want the capital to remain fixed. This is the requirement of the partner. The partner is saying that if it is 30,000 or 25,000 is my capital, I don't want the capital to change. I want the capital to remain fixed. So in that case, they want to follow a method of capital which is called the the fixed capital method. Why do they want to make a fixed capital method? Because they want the capital balance to remain fixed. The partners do not want their capital account to change. They want the capital account to remain what? Fixed. So in that case, what do? We say, okay, fine, you want the capital account to remain fixed, no problem. Let the capital account remain fixed. So what will you do? How will you do? How will you make the capital account same? They say not a problem at all. You want the capital account to remain what? Fixed. So in that case, you will prepare two capital accounts. What is the two capital accounts that you will prepare? You will prepare two accounts for the capital. The first account will be called the partners capital account. What will the first account be called? Partners capital account. What is the purpose of preparing two accounts? What is the purpose of preparing two accounts? What is the purpose of preparing two accounts? They want the capital amount to remain what? Fixed. So in that case, your partners will prepare two accounts. The first account will be the capital account and the second account will be the current account. Okay. What do the partners want? The capital balance to remain the fixed. So they want the capital balance to remain the fixed. So they will prepare two accounts. One will be the capital account, one will be the current account. What will they record in the capital account? In the capital account, they will only record the opening capital. In the capital account, they will only record the opening capital. And if there is any additional capital, so they will record that. Okay. If there is any additional capital, they will record that. And everything else they will do in the current account. Everything else means what? Everything else. So if there is any additional capital, it will come in the capital account. Nothing. Everything else will come over here. When I say everything else, that means the interest on capital, salary, profit, drawings, interest on drawings, everything will come over here. Balance begin down will be the current account balance. Balance begin down will be which account balance? It will be the current account balance, and the current account can have a credit balance. It can have a debit balance. So when they want the capital account to remain what? Fixed. In that scenario, they will prepare two accounts. One would be the capital account, one would be the current account. In the capital account, they will only write the opening capital, closing capital, finish. Opening capital, closing capital, finish. And in the current account, they will do everything else. Are you with me? Just keep this in mind, the current account scenario. And over here, this is the latest question paper of Feb-March 2023, 0452, where you're supposed to prepare a profit and loss appropriation account and you're supposed to prepare a current account. Okay, keep this in mind, prepare the profit and loss appropriation account, and they want only one partner's current account, that is Punita's current account. 1 minute.